A single line in a 1976 Emiri decree severed Abu Dhabi's oil wealth from its own government, permanently by law. The decree established the Abu Dhabi Investment Authority, ADIA, as a legally distinct entity from the state budget, with assets that could never be classified as government revenue and could never be drawn on for annual spending. Not a savings account, a wall. And once that wall went up, no elected body, no finance ministry, and no future ruler could legally reach across it without rewriting the founding statute itself. That is the mechanism. Everything else, the scale, the secrecy, the 5 decades of compounding, is downstream of that one clause. Before that decree, Abu Dhabi's economy ran on pearls and fish. Through the 1950s, its export base was almost entirely maritime, a subsistence trade with no industrial base and no meaningful fiscal apparatus. Oil changed that starting in 1962, when the first commercial exports began, and the change was not gradual. Within a decade, government revenue moved from negligible to hundreds of millions of dollars annually, then accelerated hard after the price shock of 1973 to 1974, when the oil embargo years roughly quadrupled global crude prices and Abu Dhabi's export receipts surged correspondingly. The problem this created was not scarcity, it was absorption. A territory with limited paved roads, no meaningful capital markets, and a population in the low hundreds of thousands could not physically deploy that volume of incoming cash into productive domestic assets fast enough. Every other oil exporter facing this exact bottleneck in the 20th century had solved it the same way. Spend it into the domestic economy, inflate the currency, or let it get captured by whatever political faction controlled the treasury that year. Abu Dhabi's ruling structure, watching Venezuela and Nigeria do exactly that in real time, chose a third option: legally remove a portion of the money from the spending cycle before it ever became politically contestable. The mechanism itself was precise. ADIA was chartered as an independent statutory body, reporting to a board under Sheikh Zayed's direct authority, structurally insulated from the Ministry of Finance and from the annual budget process entirely. Its mandate was explicit: invest surplus oil revenue for future generations, not fund current year government operations. And its investment rule pushed the overwhelming majority of assets outside the UAE and outside oil-correlated instruments altogether. Foreign equities, developed market fixed income, international real estate, private equity abroad. The logic was mechanical, not ideological. If national wealth stayed denominated in oil-linked assets inside a single hydrocarbon economy, a price collapse would hit the sovereign balance sheet and the investment fund simultaneously. Moving the capital abroad into asset classes with no structural correlation to crude prices decoupled the fund's solvency from the resource that created it. This was only possible in 1976 specifically, not before and not after. The 7 Emirates had federated in 1971, consolidating fiscal authority under a structure where Abu Dhabi, as the dominant oil producer, held effective control without needing to negotiate resource allocation against 6 other Emirates through any parliamentary mechanism, because no such parliamentary mechanism with budgetary teeth existed. There was no opposition bloc to argue that surplus revenue should go to public spending instead of an offshore fund. There was no election cycle demanding visible short-term returns. And critically, oil revenue was arriving faster than any domestic project pipeline could absorb it, which meant locking a portion away didn't visibly cost anyone anything in the near term. Earlier, there wasn't enough surplus to make the exercise meaningful. Later, once domestic institutions matured and stakeholders multiplied, removing that scale of capital from public claim would have been a political fight. In 1976, the money was too new, the surplus too large, and the governance structure too concentrated for anyone to object. What followed was compounding, uninterrupted, for 5 decades. ADIA does not publish a full assets under management figure. That is a deliberate policy, not an oversight. But independent estimates from sovereign wealth fund trackers place its holdings in the range of $700 billion, some estimates running higher, none of them confirmable against an audited public disclosure because none exists. That zero disclosure posture is itself part of the engineering. A fund with no public reporting requirement faces no market pressure to justify allocation decisions, no analyst scrutiny of underperforming positions, and no domestic political debate about how the money is spent, because from a legal standpoint, no one outside the board has standing to ask. The second-order effect of this scale was structural. Abu Dhabi stopped functioning primarily as a commodity exporter and started functioning as a global capital allocator, holding positions in Western infrastructure, listed equities, and private equity funds that generate returns with no linkage to the price of a barrel of crude. The third-order effect was that this accumulated capital base became the collateral behind Abu Dhabi's move into non-oil sectors, Mubadala's industrial and technology stakes, the build-out of Etihad, and the aviation sector. Funded from investment returns and separate sovereign vehicles rather than from borrowing against future oil production. The Emirate diversified its economy using yield from money it had already extracted from the ground decades earlier, not debt issued against oil still underground. The cost structure runs in the opposite direction from the benefit. Total opacity means there is no domestic mechanism by which a citizen, a parliament, or an auditor can assert a claim on the fund's assets or challenge an allocation decision. The wall, built in 1976 to protect the capital from short-term political raiding, also permanently protects it from long-term public accountability. Capital that flowed abroad into foreign equities and real estate was, by definition, capital not deployed into faster domestic diversification, housing, or non-oil industrial capacity inside the UAE during the decades when that capital was accumulating. The entire structure rests on an intergenerational trust bet that a fund with no audit trail, managed by an unelected board, will still serve the interests of citizens 2 or 3 generations removed from the 1976 decree, with no contractual mechanism forcing that outcome. And domestic sectors, housing, small enterprise financing, non-oil job creation in the 1980s and 1990s, received a smaller share of oil-era surplus than they arguably would have under a budget process where legislators had to publicly justify spending trade-offs. There was no such process. That was the design. ADIA today sits among the largest pools of capital in the world, engineered specifically to outlive the oil reserves that funded its founding contribution. Reserves that, at current extraction rates, have a projected horizon measured in decades, not centuries. But the fund carries the exact fragility written into its founding logic. There is no external check on its governance. No legislature can audit it. No court outside the Emirate has standing to compel disclosure, and no market forces it to justify performance to shareholders because it has none in the conventional sense. Its stability depends entirely on continued consensus among Abu Dhabi's ruling elite that the 1976 mandate should still be honored. A structure built for permanence was, by the same design choice, built with no mechanism to course correct if that consensus ever fractures. For any other resource-rich state studying this model, the trade-off is precise and unresolved. The legal insulation that guarantees a sovereign fund's durability across generations is the exact same insulation that guarantees its unaccountability to the citizens whose resource wealth it holds. No country that has attempted to replicate Abu Dhabi's 1976 architecture has yet found a legal structure that delivers both.